You should get a hat that because you need the aluminum today because all those conspiracy theories are all coming true.
Well, we went over that last week, Doug, and we ran out of conspiracy theories because they've all come true. I think there was another one that came true.
I think you need to take your tinfoil hat and on the show sometime melt it down.
I need to create a sustainable one. I'm afraid that one's going to break. I put it over there. I'm like, somebody steps in that, I'm done. Anyway, all right, let's go live here. Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Greetings, Kirk. Happy Friday to you. I had to check that it's Friday because sometimes we're on Monday, and occasionally I can't get into my office or my tech to work. So I just have to make sure.
Yeah, the last one you were in a hotel somewhere.
Yeah.
We were official. It is officially Friday. I had to look as well. It's been a long week with the war. With all the war porn we're getting, and I'm getting a little exhausted by trying to keep up with everything. I will say there's one interesting thing because I don't watch major media news. And I've been trying to teach my kids on how to digest stuff like this. And my son was asking me, he's like, what do you watch? What do you listen to find out what's going on? I'm like, I don't. I basically have my sources that I listen to for other stuff, and they communicate things that are going on. And effectively, that's how I'm finding out. But there's very little. I think Trump has come out and said 2 or 3 things, but otherwise not much has been said. How do you know what's true, right? I've seen a lot of fake videos online. I've seen a lot of, like fighter jets doing all this cool stuff. I'm like, that's AI. That's not even real. And so, I find it interesting because you don't really know what's going on unless the government tells you. And even then you're, like, is it true? So, it's been an interesting week with the war. But I guess the lesson I'd leave everybody with the war, and I don't want to get too crazy on it today because there's some stuff I want to talk about, is that, the fog of war is real. Like, you need to really slow down the digestion of this. I think initially they said, oh, it'll be over quick, we'll kill leaders. And then it was 2 weeks, and now it's 4 weeks. At this point, I don't know if Trump wants to get reelected because if this lasts a month, I'm not sure it's going to fly unless gas prices go under $1. Then maybe people forgive him. But I think for the most part, it's against what everybody voted for. Everybody voted for him for being anti-war, and he just went and started a war.
Well, I got good news. He can't be reelected. Although get your tinfoil hat on because he's the rumor is he wants to.
Right. Sorry, I meant midterms. I keep saying that, but yeah, no, it's funny. You know what I found the most funny was prior to, it was like after the election. It was like last summer when the No Kings rally started. And I started to see, I'm in Lexington. It's filled with, liberal Democrats. And I started to see these signs. It was like 1776 and like No Kings. I'm like, what is this, a theatrical production? Like, what is this? And no one was talking about it yet, but I saw all the signs in expectation of this blowing up. And then it kind of blew up. And I was like, this is a non-starter. And it ended up being a non-starter. They had a rally and nobody showed up. And it was like, this is not, like, what are you doing? Like, this is like the worst marketing campaign I've ever seen. Like, if you're, the first thought that came to my mind is, you're saying no kings. You're basically, when you say no kings, and this is actually an interesting lesson for psychology. If you say no kings, what you're saying is king, because your brain, when marketing, your brain doesn't process no. So when it said no kings, you're basically saying Trump's a king. Like, the PR message that your brain is getting is Trump's a king, Trump's a king, Trump's a king. Well, Trump never said that, but all the liberal Democrats are saying that. So they're conditioning everybody that he's a king. Well, if people like him, they might want a 3rd term, even though he can't technically do it. So they're doing the exact opposite of what I think they were trying to do. And I say this because people do this in marketing a lot. No X. Well, what you really mean is X. And so, and I'll use a few examples because Lexington is always a hotbed of liberal Democrats. Like, kind of like picketing and stuff like that. So one thing they had, because they had the Black Lives Matter, and then after that, because there's a lot of Asian people in Lexington, they had a Stop Asian Hate. And I didn't follow the news, so I don't know why that was there, but it said Stop Asian Hate. And the first thing I'm thinking with my marketing brain is what that really says is Asian hate, because your brain's not seeing the stop, the word stop. So they're conditioning people with that. I'm like, that's just, you got to come up with a better message. It's just the negative messages don't do what you think they're going to do. So I know we should talk about investing, but I see these things and it makes me scratch my head. Like, who's in charge of this? You need a better marketing department if you're trying to convey a message, and you can't start with a negative because your brain doesn't process it. So if you're thinking of marketing, don't start with a negative because the brains won't see it. They'll actually see the opposite of what you're saying. So just a marketing tidbit. So we've had the weirdest week that I have seen in a long time. I've been watching the markets every single day just out of curiosity. And we were oddly enough positioned for this, but still I was curious. So Monday, the markets were up. No, they were up for the most part. I mean, I think tech was down, but the markets were up on Monday. Tuesday, they were down. They're down a lot. Scared people. Internet, some things were down a lot that were up on Monday, oddly enough. Or if they weren't up, they were down a little bit. So it was like, oh, this is weird. Like, nobody seems to care about the oil was up, but nobody seemed to care about the other stocks. I was puzzled by Monday. Tuesday came and cleaned everything out. Like, international was down a lot. I mean, everything was down big. Wednesday, everything's fine. Everything's fine again. Markets are up. They're up big. Oh, it's all great. Thursday is down again. Okay. Today's down again. Okay. So what's interesting is, and I want to use this somewhat as a lesson today as I'm kind of watching the markets a little bit here to use this as an example. But what I want to talk about today is this, is that the markets don't necessarily operate in a logical way like you think they would, right? War in Iran, bad. Stocks, bad. Bonds should be good because flight to safety, all that. But that's not what's happened this week. So Monday, things were very lukewarm in the markets. You would think that there was no war on, basically, for what happened. It would have just been an ordinary day, except for oil spiking. But the rest of the markets were fine. Tuesday, I looked at my screen and everything was red, except for two things: US dollar and software stocks, oddly enough. Everything else was red. Everything. Bonds, stocks, current, everything was red. Now, if you look at the markets, right, the markets operate based on liquidity, right? There's money floating around and it has to find a place to go, right? It's either in cash, it's in bonds, it's in stocks, it's in currencies, somewhere, right? It has to be somewhere. It can't just be in nowhere. It can't disappear. So where is the money going? Well, obviously with the war, it went into the dollar. Safety, more money went into the dollar, which creates other problems, but money was flooding into the dollar. Okay. But where else did it go? Well, you think it would be in bonds because bonds are safe, but it wasn't going into bonds. Bonds were down. Bonds were down a lot, especially long-term bonds. You'd think, well, that would have been safe, but it wasn't safe. Okay. Well, it could have gone in cash, but oddly enough, it went into software stocks, which I'll talk about in a minute. Here's the reason. And this is interesting. I learned this week. I've seen this many times, but here's the reason. The market has a lot of leverage built into it. So when the market has leverage, when you're selling something, it doesn't mean it's going into something else. It means that you've taken $1 and created $2 with leverage, right? So if I take $1 and buy Microsoft, and let's say Microsoft's trading for $1, and I buy $1, then that's what it's worth, right? But now if I go buy 2 shares of Microsoft with my $1, now I've got leverage. I've got 2-to-1 leverage, right? And so now I have, if Microsoft's going up, I make lots of money. If it's going down, I lose lots of money, right? That's how leverage works. But also when you have leverage, you've created money out of nothing. So if I have $1, I buy 2 shares instead of 1 share of Microsoft. I basically I've created two $2 worth of value. I've leveraged up my dollar. Now it's worth 2. But if I sell that one share of Microsoft, I've destroyed $1 in the system. But I still have a share of Microsoft. So it didn't turn into anything else. It didn't turn into cash, didn't turn into bonds. It just disappeared because it was leverage. So what's happened when these days, and today it's not as bad as Tuesday or yesterday, but when you see all red, nothing else, it means leverage is coming out of the system, because that extra dollar you created disappears and doesn't turn anything else. Whereas if I sold all of my Microsoft shares, I'd have $1 and I'd have to put that dollar somewhere else. That would go into cash or bonds or some other stock, right? So what's happening when you see these very big red days across the board and money's not going anywhere else, it's largely because it's deleveraging the system. So leverage is coming out of the system. Now, we had a lot of leverage in the system prior, and you could look at some of the dynamics. I don't have a chart, so I can't share it, but just understand that there was a lot of leverage in the system, and that is coming out. And so what we're starting to see is that. Now, the software thing I want to touch on as well, because I was puzzled and I talked to a few people and realized what it was. So there's a thing called a pairs trade, which I can maybe cover today or a different time because it's complicated. But basically, you're buying one thing and selling a different thing. So in the last few months, software has dropped a lot. The software ETF, I think, was down like 40 or 50%, whereas semiconductors were standing solid. But they're both related, right? You need both. If you have semiconductors, you need software to run it. If you have software, you need semiconductors to run it, right? They're interchangeable. They're necessary. However, you started to see software stocks drop because everyone was worried that AI is going to destroy software stocks. I don't know if that's true or not, but that's what the fear is. So semis were fine. Semiconductor stocks were fine, right? The NVIDIAs, the Micron, and all that. And then all these software stocks, even Microsoft, Adobe, like all these companies were just getting crushed. Well, a lot of people do a pairs trade. What they would do is they'd buy semis and they would sell software. So you're neutral. So you don't have risk. So if the market if everything drops 50%, you're neutral. You're not going to drop 50%. What you're making money on is the difference between the two investments. So a lot of hedge funds would do this. So what I think was happening is a lot of hedge funds were buying semis and shorting software, and they were making lots of money. I think there was like a 50% drawdown. So there's a lot of profit to be made there. But when you're trying to unwind that, how do you unwind a pairs trade? If you've bought semiconductors and you've sold software, in order to reverse that, you need to buy software to close out the position and sell semis. So you've noticed that software has been going up regardless. And I don't think AI has changed the game in the last week, but software has gone up in the last week, and semiconductors have actually, I'm just looking here, and semiconductors have actually come down about maybe not quite 10%, but they've started to sell off. So when you're looking at markets, this is why we talk about on the show how you're never really going to know what's happening behind the scenes. Why did this sell off? Why did it not? Sometimes you're never going to know. In cases like this, it's easy to figure out because everything's dropping. And if something isn't, you're like, why isn't that? And you come up with thesis and you're like, this is actually a really good reason. A lot of people were shorting in software, but now they have to exit the short, so they're buying it back. So a lot of that is going on right now. A lot of people are jumping to the sidelines. They're getting out. They're like, we'll figure this out later. We'll wait till after the war. I mean, if this war lasts a month, the stock market's probably going to be a lot lower. I wouldn't be taking a ton of risk here. We've talked about this in the show for the last few weeks. You should, de-lever yourself and take less risk and wait till the sky's clear. You don't have to pick the bottom. Just make sure your risk is lower. And right now the risk is kind of high. So it makes a whole lot of sense to just be patient. Don't try to pick bottoms just because things sold off. Don't be like, oh, I'm going to buy the dip. Let me tell you something, and I'll give it back to Doug. There's a concept you need, if you learn nothing else today, learn this. Buying the dip is a good strategy in bull markets. Only in bull markets. In bull markets, buying the dip means that you're buying it cheaper and then it goes up. Buy the dip and then it goes up. That's a good strategy in a bull market. It does not work in a bear market. Buying the dip means you're losing money. So here's what happens in a bull market: it goes up and then it comes back a little bit. Buy the dip, goes up, comes back. Buy the dip, keeps going up. So you're dollar cost averaging. So people dollar cost average. You do that that's a good strategy. But if the market's going down, it drops and then it pops up and then drops more, pops up and drops more. So in a bull market, buying the dip is a good strategy. In a bear market, it's called selling the rip. So you don't buy the dip in a bear market. You sell the pop. So it drops a lot and then it comes up a little bit and you sell it at that peak and then it goes down more. And you wait till it comes up a little bit, sell it, and then goes down more. It's the reverse of buying the dip. But most people don't short, and I'm not suggesting you do that. I'm just talking about the concept. Institutions do this. They call sell the rip. So we are not in a bull market right now. Now, you might say technically we are based on fundamentals or technicals or whatever. I'm just telling you, when there's a war on, there is no trend right now. The war, anything's up for grabs. Anything can happen. You cannot predict anything. This is why people de-risk, they de-lever, because they're like, hey, I don't know what's going on. I'm just going to sit in the sidelines and wait it out. You don't have to make a trade now just because there's a war going. You can sit in the sidelines. It's okay. It's okay to do that. You're not going to miss out. So when you're thinking about investing in a market like this, you should, whatever risk you're taking, take it down a notch, 2, 3 notches if you want. We're doing that. People are like aggressive, like, no, we're taking the risk down. We're not taking that kind of risk because we know things could get crazy and could get crazier. We don't know. I can think of a lot of scenarios of things get crazy, but anyway. So I just want you to think about the people who are out there buying the dip of all these tech companies that are like, oh, they're cheaper, Bitcoin or whatever you're buying. You're looking at the equation wrong. It's going to get you in a whole lot of trouble and you could lose a whole lot of money. What if the markets drop 50% from here? How is that buy the dip strategy going to work? Not very well. So if you're dollar cost averaging down all the way, you're going to lose a ton of money. This is why cash is important. So be careful, have the right framework with your investing right now, and don't buy the dip. Okay. Better off just waiting until it does. If Trump says tomorrow, all right, everything's done, we're done, the market shoot up 10%, it's okay to miss that. Believe me, it's okay. You'd be better off just finding a calmer time to invest where it's more predictable. Right now is completely unpredictable. What are your thoughts, Doug?
Well, before I give you my thoughts, Kirk, I want to, because of what you said, I want to put it back on you for one more thing. So obviously you said, don't buy the rip, right? Just because I'm sure there's some curiosity right now. How would someone potentially get an idea whether or not we're in a bull market or a bear market? Like, what should they be looking for to say, okay, this is a bear market, so now is not the time?
That's a great question. There's a few ways you can do it. Okay. If we were not in a war, I would say we were still in a bull market. So there's some really simple ways to do that. And you could do, if you're looking at from a technical perspective, which I suggest everybody learn some basic technical analysis, and it doesn't have to be crazy. It can be simple as a moving average. Now, if you know nothing about investing and you're an indexer, the simple way to look at it is this. There's what we call moving averages. And the moving average is looking at the past price for the last 20 days, 50 days, or 200 days is typically what people look at. So 20 days is a month, the 50 days is a quarter, and 200 days is a year. So people look at those time frames as moving averages. And you want to use those because everybody else uses those. You don't want to be, this is not a time to be different. The markets operate on crowd thinking. So you want to use the indicators everybody else is using because they're going to see those things and you want to see the same things they see. So most people look at either one of two things. It's either, is the price over the 200-day moving average? That's a simple one. If the price is over the 200-day moving average, we're in a bull market. If it's under, we're in a bear market. Okay. A one level up way to look at it is the 50-day moving average above the 200-day? And if you go to any sort of website that has charting or anything, they all have these. So just it doesn't require a deep level of sophistication. Just find a chart that has moving averages and it'll do it all for you. Really simple. So is the 50-day above the 200-day? If the 50-day is above the 200-day, it's a bull market. If it's below, it's a bear market. Those are things that I would use. The 200-day is the simple one. That's really simple. So those are how most people look. Are we in a bull market or a bear market? Okay. Now, if you're into fundamentals, fundamental analysis, where you're into the numbers and the, and the financials of the company and the annual statements and all that, you might be able to look for themes. You might be able to look for trends in the numbers and say this company isn't growing. Like we use Apple as the whipping boy all the time because Apple's revenues and profits haven't grown in like 3 to 4 years. Well, okay. If you're expecting growth and you're not getting growth, then there's a problem, right? There's a disconnect between what you think you know and what is reality. So is Apple in a bull market? I would say it's in a sideways market because it's not growing its revenues. If it starts to grow, I'd say, okay, it's more in a bull market. That doesn't mean the price will go up, but it's fundamentally over time that should translate into higher prices. So it depends on which lens you're looking at it. I like the technical analysis lens because it's simple. I don't need to go through annual reports in 5 minutes to figure out if I'm making a buy or a sell decision. I can look at the charts and say, are the charts a bull market or bear market? If it's a bear market, I get out. If it's a bull market, I get in. I can do that very simply and just say, this is it. I got a stop loss. I'm out. That's really important when you're managing portfolios, unless you're a buy and hold for life kind of person, which I don't think is the best, but I understand. I don't agree, but I understand for some people it might be a good fit. So I don't know. That helps, Doug.
Mm-hmm. Yeah. So, I mean, I think a couple other things that are really, what's really going on right now? I think there's a couple things that are hitting all at once right now. And, the narrative for months has been there's going to be a soft landing. Today, especially today, when it came out, that narrative changed to a potential stagflation risk. We've been talking about it off and on for a while. If we're going to look at anything this economy could potentially become, of all of the historic occurrences that have, that we've gone through, stagflation was the one with the potentially highest risk. It wasn't there because we haven't, we've had inflation be more tempered, nowhere near the 14%, that we saw during the stagflation era. And we've had the markets for the most part have been performing, which is nowhere near the average 1.6% average of the markets during that, 1968 to 1982 curve. But, it didn't, if we think of it more of a needs-based versus wants-based scenario, we've probably been closer to that 14% than people realize on the inflation side. I mean, people recognize that, maybe overall inflation numbers are down, but as we've talked about before, nobody gives a rat's what around TVs. Discretionary items, have gotten cheaper forever, but push comes to shove. If you're trying to heat your house, if you're trying to run your house off power, as we know, we're all competing now with the energy needs of a lot of these data server farms and data centers. If you're trying to feed, they said they're going to be a multi-year shortage of cattle. So again, beef prices were already expensive and now, expected to go even more through the roof because we don't have the supply anymore. And that's economics 101, right? So we have lower supply. We already had, higher demand, and maybe the demand will come down because of the pricing, which is generally what you'd expect to happen. As prices go up, the demand will subside as people can't afford it. But there is still so much liquidity and wealth in the system that it has been able to be, for the most part, absorb most of the higher costs that we've seen. And up until this point, oil's been really inexpensive. So that is generally a big indicator. Well, guess what? We just lost 92,000 jobs in February, right? And so they just announced that. That's a pretty significant hit when they had originally said that they were, that the jobs were positive. And now, again, get used to This the same old, same old. They just revised it down. Unemployment's now up to 4.4%. I mean, that's not terrible, but it's definitely rising. And it's, an unexpected. And at the same time, now we've got the Iraq war pushing oil to $90 a barrel. And it's seeing its largest weekly surge since 2020. $90 a barrel is not good. When, it's okay, it's absorbable for now, but, there are correlations of economic and market, resiliency. When you start getting in the $100 plus barrel, we start getting to 120, 150. If it gets there, it has generally been pretty consistently deflationary for the economy. So right now the markets are I'd say they're tempered on it. I mean, last I looked, they're down about 1% on the Dow, S&P. Hit harder. They have the least resiliency to this. And so, I mean, that to me, a 1% move's not that, not that much. And they're still, but they, I think, as you said, they're being cautious, and we'll see what happens. What the market really cares about Iran, it's not the war itself. It is where it sits geographically. I mean, it's on the Strait of Hormuz. That's 20% of global oil flows through that corridor. Listen, the big play here, this is a China play. I mean, fortunately for the United States, and again, oil prices and average oil prices, we certainly see that, we certainly feel that. But as I said last time we spoke, we silently became the world's largest producer of oil. We also just built potential relations with Venezuela that we haven't had in, decade or decades. And that is one of the largest oil reserves, although it's not some of the best oil in the world. It is a huge reserve, and so is Iran. So right now, energy ministers are warning of Gulf production could halt if the war expands. And guess who cannot produce oil? That is China. They are a user of it. So this is I think underlying here is the potential that this is an economic play and a squeeze on China. But there is a lot more that can go in with this. And a lot of times, as we saw with the Iraq war and Afghanistan, unfortunately, we like to go in and say victory declared in a short period of time. We'll see what happens, but I'm not personally confident that we're going to be able to get in and get out in a couple of weeks, like they said. And they're already talking about some challenges. So scenario one, we get a contained conflict. Oil stabilizes around $90 to $100 a barrel. Market digests it. Everything kind of calms down. Significant Hormuz disruption for a long time. You could see oil spike to 120 to 150. That is a global inflationary shock. Okay, and that's when you could start to see. And this is another reason right now to be cautious, because I think like you just said, Kirk, 50 and 200-day moving averages. We're not quite, depending on, we're not quite there yet. And right now the pricing for the S&P 500 is above some of those averages still, but it's rapidly approaching down to what those averages are and could crash through. And at that point, it'll sneak up on you, but all of a sudden it is a bear market. But if you look at what what is the whole idea of investing is, look at your work, be conservative and look at what your most conservative scenario is. Like you said it best, if the market rebounds, everybody's happy and moves up. Okay. Yeah, that hurts to not be in it, but what's going to hurt worse? The reality is losses compound more than gains. They not only compound more than gains on a monetary and numerical standpoint, but they absolutely compound more than gains on an emotional standpoint. So again, looking conservatively, if this Hormuz disruption begins to be a significant issue, are you going to be more concerned that you are out of the market if things stabilize? Or are you going to be more concerned if you're in the market if things get worse? They don't, markets do not crash from wars. They crash oftentimes energy shocks and credit crises. Let's just, let's not even get, I'm not even bringing up the reverse carry trade and the yen, which have continued to be out there as possibilities. And if we want to go back and look at stagflation as a historical scenario, the 1973 oil embargo, and there's a lot of things that have changed since then, but that's probably your real parallel. If we get back to the job shock, the bigger shock is this data. They expected to get 60,000 new jobs. They lost 92,000. Surprise, surprise. One thing I think the market is probably at least prepared for is we've been hearing these revised numbers now going back years. And I think thankfully, people are already numb to how stupid these number reports are. This is the second largest monthly decline since the pandemic, and at the same time, wage growth is still 3.8% year over year. That is a policy nightmare going into the midterms. I mean, the Fed wants inflation falling, they want job stability. Instead, they're getting jobs weakening and energy inflation rising, and that is the absolute definition of stagflation risk. And so if we go further in that, those energy shocks can ripple through everything. Higher oil means higher transport costs, and they're already talking about that. Higher food prices, right? How we get our food, how we transport our food, how we grow our food, how we, all of it is reliant on energy. Higher manufacturing costs, higher consumer inflation. And that's already after there's been talk of whether or not we're starting to see the impact of tariffs coming in on inflation. Now you've got this potentially with energy that hits consumer spending. Retail spending has already underperformed earlier this year. So if you add weaker jobs, higher oil, volatile markets, you start to really pressure the groups that I have, I've been talking about, that are struggling with the, with student loan payments going back in, mortgages. We've seen more and more of them falling into default. Things ripple up from the bottom, right? So eventually, it's been resilient as an overall economy because, again, the haves have a lot and the have-nots are kind of being tempered by that. But the reality is that the haves are going to start pull back too, and that's when you start to see the boulder flying. This inflation caused by demand can be manageable, but inflation caused by oil shocks, that's dangerous. Couple more things. Markets, is the collapse of rotation. We've talked about rotation. It's still, my opinion, Kirk, it still looks like rotation, not collapse. I mean, we're seeing energy stocks up, defense stocks up, gold, commodities. I mean, those are still holding well. This was truly an economic shock. You probably see, gold and commodities other than oil right now, given the circumstances, get hit. Tech's been holding recently, but overall this year down. Consumer cyclicals not doing great right now, which are, and small caps. A lot of this is classic risk off positioning, the reallocation of capital. Nobody's yet liquidating everything. That's why the markets are moving like 1% here and there, maybe a big day, but not like a big sustained day. And the real collapse signals to watch credit spreads. If they start exploding, or you start hearing about banks under stress, or treasury auctions failing, or liquidity freezing, that's when you really want to be careful. None of that is happening yet. And the other thing is the dollar's going up. You mentioned that. The dollar spike, it's also predictable. In crises, global markets will move to safety. And you said, I think you said this last week, treasuries, dollars, gold. And we're seeing gold hold up a little bit right now. I mean, it had a down day there, but it's still feeling, fairly stable. Treasuries, I just looked at the Treasury ETFs. They haven't been spiking, but they've been holding. They've been moving up slowly, and the U.S. dollar is moving up. Again, globally, that's still considered a flight to, a place to be for safety. It's a flight to liquidity trade. But the paradox here is that long-term fundamentals for the dollar are still huge deficits, record sovereign debt, massive treasury issues. So we've got strong, short-term strength, long-term fragility. And dollars rallied during fear, but they weakened during peace. So that's why a lot of you're seeing right there. Just understand there's a market narrative going on that's really outside of reality right this second. And, but be very careful going into the next couple of weeks with what ends up being the outcome of this conflict. If it is sustained, I would be very concerned. I'm sorry, if it's contained, I would be very, I think we're going to turn back to a normal. But if it's sustained, I would be very concerned. And again, you have to look internally. What about risk are you willing to take right now? And what's going to hurt more? Missing a little upside or potentially being stuck if things start to exacerbate.
Yeah, it's some good points there, Doug. In some areas I want to kind of touch on here is when you're looking at risk, right? Right now in the markets, we talked about how the markets have digested the war news, and Doug mentioned, rotation. we've been talking about on this show, we've been talking about it for weeks before the war on how the rotation was going on. And we talked about how it was going and where it was going to go. And these are normal market functions. The market is normal when a rotation is happening, right? You're still in a bull market. Just because tech's going down, it doesn't mean that we're in a bear market, right? It means you're in a rotational market. Because if you look at the index, right, if the index is stationary and tech's going down, something else must be going up, or a lot of things, because tech's like 33% of the index. So you need a lot of things going up. Well, that means money's coming out of tech and it's going to other areas, right? That's a rotational market. That's a healthy market. That is the way the economy should work, is that it goes from one area to another area for various reasons. And if people really don't like the economy, then they go into bonds, right? So it's from tech to staples and utilities and healthcare. It used to be tech, discretionary, and it's rotated, and that's good. A lot of money went into energy, industrials, materials. Those have done very well. And those are the hot areas. We started to rotate into some of the other areas like staples. Like staples actually was one of the best performing sectors this year prior to the war. Obviously, energy and industrials were doing well as well, and materials obviously did well. So when you're looking at portfolios, right? If you're looking at the market right now, you're saying, all right, should I change my portfolio or should I stay the same? I know that's going through everybody's head right now. All right, well, here's how to think about it. First off is you should have a stop loss. You should have a point where you're like, all right, if it hits this point, I'm out. Now, I've done that this week. I got hit a bunch of times, and that's okay. I'm fine, because if I get stopped out, I'm fine with the price I got stopped out at, and I'm in the cash, and I'll just wait in cash until things are over, and that's it. That's a healthy way to do it, because you're not trying to time the market. You're not trying to discern what's happening over in Iran. I can guarantee you, I don't know what's happening in Iran, and neither do you, and probably neither do half the people in the government.
No, the Middle East has always been an area where no matter what, the CIA and the Americans have tried to find out what's going on there. Everybody who's ever been involved with world policy in that area has said it is an absolute chaotic cluster. That anything can happen.
Right. So we're not trying to predict the future. We're not trying to be the most intelligent person on the planet. You're just saying, look, my risk is this. I mean, I'll give you an example. So we were in international stocks this year. We had some positions. We had some starter positions. And Monday, I was going to sell because I figured, well, the strong dollar will be bad for international stocks, which it is. So Monday, we had a strong dollar, and international stocks were like, it was down a little bit, but it was fine. I was like, okay, maybe we're going to be okay. And then Tuesday, it was just ugly. I was like, all right, hit my stop loss. I'm out. I'm just going to wait in the sidelines. I don't need to play in the game. Who knows where it's going to go? I'm happy to not participate for the next month or however long the war takes, and just sit in the sidelines. It's okay. Cash is your friend sometimes. And in a war, cash is your friend. So we started talking about the rotation, right? Rotations are healthy, but when you have a war, it just throws all the rules out the window. There are no rules in war. So if you're looking at the market saying, well, this doesn't make any sense, it's not going to make any sense. It's a war, and you don't know what people are doing. They're not making rational decisions. My positions are getting stopped out, which I'm okay with, because it means I'm not taking heavy losses. It means that, it's down a little bit and then we're out, and then we have no more risk in that position. I'm okay with that, right? Now, if you're holding Bitcoin at the peak and you're still holding it, you're down, whatever it is, like 50%, something like that. That's risk. Now, you might say I'm okay with that because I'm just going to hold forever and it'll go back up. If that's your thesis, that's fine. But if that's happening in a stock, 50% is a lot for a stock. So you might be making a material mistake because the stock's down 50%. You might say, well, if I got out when it was down 10, I'd be okay. Now, you're probably thinking, yeah, I know, but I'm buying the dip when it's down 10. Yeah, but we're no longer in a bull market, right? Maybe when the war is done, we'll see if we're in a bull market again. But until then, we're in the twilight zone. So there are no bull markets or bear markets during a war. There are no rotations in a war. You just hit your stops or you get out early, and that's it, and you sit in the sidelines. That is the safest thing you can do. Now, there have been wars like 2003 when we went to war with Iraq. I know they're not called wars. They're called military conflicts. So sorry I'm using that pejorative word of war, because we haven't been to a war since, the World War II? We've been in military conflicts. whatever, it's a war. So, we're in this war and we have to throw everything out the window because we don't know what's going to happen. And I'm not going to, throw scenarios out there, but we all know them. Bad stuff could happen. Bad stuff could happen here, right? They could have sleeper cells. Who the hell knows what's going to happen? The whole world can get into turmoil, or it might be a whole lot of nothing. We don't know. But what we do know is that things are not operating normally. Okay. Now, once the war is over, or at least declared over and everything's safe, people will jump back in. They'll get back in their positions. You can just jump back to where you were before. And so what if the market pops up like 10% in a day like it did in the tariff tantrum last year? So what? Doesn't matter. I'm okay with that. Like, I'm not looking to shave a nickel every single time. I'm looking for trends, things that are safe, that can make money consistently. I'm happy to sit in the sidelines because if it goes down 50%, I'm going to be pissed that I own that stuff. If it goes up 50% and I missed it, I'm okay with that as long as, there's a trend after that. The biggest challenge you have to think about as an investor is what if scenarios. If you own ABC stock, I don't know what that is, if there's an actual stock with that, but Acme Corp, right? ABC stock, Acme Corp, some imaginary company, right? You own that and it goes down 50%. Are you going to be mad at yourself? If you are, then you should probably cut your position in half and see how you're going to feel then. Well, you're probably going to feel a lot better, right? So if that's the case, you should cut your position in half now and just wait. You can always add it back later, right? You're not going to miss. You can always add it back. And then say, well, what if it goes up 50% and I miss that? Am I going to be upset? Of course you are. You're always going to want a bigger position than you have now if it goes up. Everyone. If you have your max position on, it goes up 100%. You're like, damn it, I wish I had 10% instead of 5%. You're always going to think that. So that's not a good example. But you want to look at the downside. If it goes down a lot, are you going to be mad at yourself? If you are, then sell down to the position where you're not going to be mad. So while I look at crypto and say crypto's in a bear market, it's in a really ugly bear market right now, and it could get a lot worse. I have no idea. But I'm not going to play the game. I'm in this very, very tiny position that I'm okay keeping just because I want my fingers in the game, but otherwise I wouldn't be in it at all. So you need to figure out, like, what are you comfortable with? If Bitcoin and Ethereum go to zero, I'm in the position size that I'm okay if it goes to zero. I hope it doesn't, but if it happens, I'm not going to lose any sleep over it. Okay. That's where you want to be. So that's how you should be thinking about risk management how do you look at things so that you can manage your risk on the downside so you don't get really anxious and stay up at night thinking, I wonder what's going to happen. Over this week, I've gotten to a position with our portfolios where we're down to a place where I'm comfortable. Like, I'd like to shave maybe another percent, a few percentage off into cash, but overall, I'm comfortable with where we are. Now, if I look at a few frameworks I want to share here, because I didn't share last week, so I'm going to go through them really quickly, and then I'll give it back to Doug here. So one of them is the rotational shift of commodities. Now, I've seen this a lot, and there seems to be a lot of truth to it. I'm not the expert in this, but I do know some of these. So what typically happens is there's a cyclical nature to commodities. Typically starts with gold, right? Gold tends to go up. Gold and silver tend to go up first. And then is followed by copper, right? And some of this is inflationary. Some of this is, productive. But then it's followed by copper. So copper starts to take off. And then energy, right? Energy's all sorts of energy, nat gas, oil, what have you. That starts to take off. And then agriculture. Now, agriculture is a weird sector. Okay, I'm just going to tell it up front. It's been in the doldrums for a long time. The prices are down. Farmers are hurting. I have a lot of farmer clients, and it's tough, right? It's not Great Depression tough, but it's not a bull market, let's say, in that area. But I will say at a certain point, it becomes a bull market because that's how economies work, right? The best thing for a bear market is the best thing for lower prices is lower prices. Because if prices keep getting lower, people stop producing, which brings the prices back up. The best solution for high prices is high prices, right? we have high prices, people produce more, and there's more in the market, and there's more supply, which brings prices back down. That's how the economy works, right? So it corrects itself. That's why things like rent control don't work, because if there's a problem, as long as government's not intervening and saying you can't build more, people will build more, right? And that's the nature of the economy. So the more government interference, the worse it is for the economy. So if you look at this, like agriculture, I'm starting to see some, I use a phrase from was it Greenspan, green shoots. Started to see some green shoots. But we started to see it pick up a little bit, but the war's kind of thrown it into disarray. So that's a sector I'd be paying attention to. It's a tough sector to invest in. There's not a lot of great places. Some companies are doing well, but overall, it's not doing great yet. It'll have its day in the sun, but for the moment, it's not there. So that's an example of rotational investing, is looking at areas and then looking for the next one. Now, you don't just buy ag at the beginning when gold's going up, because it could take like 5 years to get there, right? You want to wait till it starts showing you signs that this is actually what's happening. So I'm going to share these one things and give it back to Doug. So the thesis we've been going on for the last few weeks is a rotational economy, right? There's also another part of this thesis, which is the yield curve. The yield curve has been very steep, and it's starting to decline. If you look online, you can see this. It's starting to flatten out just a little bit. It's starting. Now, when you have a steep yield curve, and these are just the trends going back decades. If you're looking at a yield curve, a very steep yield curve is great for banks and financial companies, because they make money off the spread. They borrow at a lower spread and they lend it at the long spread. They make a lot of money off that. They tend to do really well in those types of economies. But if the yield curve is shrinking or flattening, as people would say, or even inverting, it might even invert, which means the cash, your short-term cash, is paying you more than like the 30-year treasuries. That's really bad for banks. Now, we had that. If you look on here in this chart, the red line is 0. Anything under 0 is inverted. Okay, it's happened a few times. Every single time, with exception of 2023, a recession has happened within, I think it was 12 to 24 months within an inversion. My thesis is 12 to 24 months after it reverts. But anyway, so we have the potential for recession next year anyway, which that's my thesis right now, is next year we'll have a recession. But if you look at this and the yield curve starts flattening and it starts inverting, that means financials and banks start to not do well. And the sector is already in trouble because of the private credit companies, which are really in trouble right now. So you want to keep an eye on the 10 to 2 yield curve, because it's gonna mean a lot for financials and the economy. I'm going to touch on this and I'll give it back to Doug. So if you have a flat yield curve, or if you have lowering interest rates, that means mortgage rates are going to start dropping. Mortgage rates are based on the 10-year, or the average. I think the average mortgage hold time is about 7.5 years now. That's the duration. But if you look at this, we had a long period of time where people had really cheap mortgages. But now it's hard to find those. So, you have 6% mortgages, actually a little bit less than 6 right now, but right around 6. So as yields drop, people start to refinance more, right? Because these low yields at 4%, they want to move, but they can't move because now it's a 6%. And they're not going to go buy a house for a higher mortgage rate, so they'll just wait. Once you get into the 5s and 4s, you're going to start to see a lot of people moving. A lot of people selling their houses, move into cheaper houses, especially in the boomers. And that's going to really change the real estate market. But these dynamics are happening now. And I would guess within the next year, by the end of the year, we'll have a 5% mortgages instead of a 4. And instead of a 6, I mean. Which means that all you homeowners are going to have a great time. That's good for homeowners, by the way. They might keep going down. I'm not convinced yet that we're there, but I think it's highly possible that it does drop. So, just start to think about how are you positioned, and are you positioned for these trends? I know Stan Druckenmiller's talking about, you should, I'm in South Korea, I'm in Brazil, and I'm short the dollar and I'm short bonds. Well, it's funny how he came out with that, and then South Korea just plummeted. It's an illiquid index. I'm sure he's looking for an exit. I'm sure he's looking for people to buy his stuff from him. My guess is he's looking for what we call a whale exit. He's saying one thing so people follow him, and then he just dumps his stuff onto you. That's why you don't follow these big whales, these Druckenmillers and Soros types, because whatever they say, they want you to do. They want you to do that so they can do the opposite. So don't ever follow those people. You can listen to them and say, "Isn't that interesting?" But I would never do that. So just keep in mind that the whole world is saying that yields are going to go up and that the dollar is going to go down, and exactly the opposite has been happening. So we'll see what happens after the war, but right now that's what's going on. So Doug, final thoughts here, and where can people find more about you?
There it is. I think as we close today, the most important thing is that, especially right now, people step back from the headlines. We've lived through a lot of cycles. The dot-com meltdown, where tech stocks got eviscerated, the Great Recession, where the entire banking systems nearly collapsed, stagflation scares, melt-ups, irrational exuberance, and sudden meltdowns. And the markets will always move through cycles. Boom, bust, fear, euphoria. What determines whether or not families are going to survive through these cycles isn't prediction. It's preparation. Right now, it's not a time to be reactive. You want to be proactive. And like we've talked about today, some of that proactivity is, removing some risk off the table now. If you have, especially if the whatever could occur could end up being worse than you're willing to be comfortable with, you don't want to look back with regret. And when we talk about financial planning with families, there's two pieces, and especially retirement and income planning, there's two pieces that we look at. There's obviously the regret of overspending your money, not having planned, running out of money. That is a very real threat to living a quality, sustained life. But for most people, and probably a lot of people that are listening to Kirk, I would say that the bigger regret that people are going to face is more likely going to be regret itself, and the regret of not having made moves or taken action when they could have, and then finding that it's too late. And whatever opportunities you take advantage of at this point is now going to have less beneficial impact to you. It's beyond your ability to be able to truly control the situation as much as you could. And again, we're talking about markets and economy. Let's be very clear. None of this is in your control, right? But you can influence, you can control the things that are influenced by it. And the most important thing you control is how much you put in place the things that ensure that what matters to you come true. And so at our company, Emergent Advisors, it's about preparation. It is about focusing on something that most people overlook, and that's clarity. We look and make sure that we're helping to map the entire financial picture, not just investments, but income sources, assets, liabilities, tax exposure, college funding, retirement income, estate flow. And when you layer all these pieces together through wealth mapping and stencils, which is a way of looking at, hey, here's your situation, here's what other people do in your similar situation. Do you have that? Are you taking this? It's something you'd want to be able to maybe look at to help make sure that what you have is much more protected and in place. But what happens is something powerful. You can not only see what you have, but you also get to see what households like yours typically have, and more importantly, what you might be missing. And ultimately, that's how you build guardrails. And that separates lifestyle from this market volatility and whatever is going to happen here. It allows families to move through everything from melt-ups to meltdowns with confidence. And that's the biggest difference between a thousandaire mindset, which people have heard me talk about, and a billionaire mindset. Thousandaires react, billionaires prepare. Preparation means planning for the full cycle, not just the good years. It means understanding boom markets to bust markets, from irrational exuberance to recession fears, calm periods to geopolitical shocks like we're seeing today. And when your financial life is mapped clearly, that volatility stops being frightening. It becomes something that you have the controls to navigate. And if you want that level of clarity, that's exactly what we do at Emergent Advisors. Check out our website, emergentadvisors.net. spelling that out for you. That is Mergent, is MERGENT, mergentadvisors.net. And then let's start a conversation, because ultimately the goal isn't trying to predict the next headline. Kirk, you and I have no clue what that's going to be. The goal is actually building the retirement income and wealth confidence through every market cycle so that you are prepared and you don't have to be in a position of having to worry about all that noise that's going on out there.
Awesome. Well, thanks for joining us, Doug. And that's the show for this week. Thanks again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisory Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app you're choosing. You can also check out our show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.